How low is low for NIO? Of last year, they did 40,000. That's awesome. How much do they make on each car? You should pay more for NIO. Question is, how much more? Okay, guys, one of the most popular stocks we get requested is NIO. NIO is a Chinese electric car maker, very large, growing like crazy. Let's pull up. But obviously, it was also a very big hype stock for quite some time. If you look right here on our chart, on our software, early 2021, very important time frame for this channel and for stocks. This is when ARK was at its peak. Jim Cramer was calling Cathie Wood a genius and all these things, and it just went like this. ARK was at 160 here. Now it's at 39 or 38. All of these hype stocks saw a peak early 2021, February, so on. If you go back and look at our videos, we were talking about how you shouldn't chase the hype. January 11th, 2021 was the all-time high of $67 on NIO. It is currently at $9.34. That's an 85% drop. Now, let's look at some parameters on NIO. Now, remember, we talk about Tesla a lot, right? And the one metric I bring up all the time that concerns me about Tesla is the price to sales ratio, all right? Now, I have said that Tesla's margins currently are better than the average car company, so their price to sales ratio should be higher, but they're selling for 7 or 8 times sales, while the average car business is selling for around 0.3 to 0.5 times sales. So 14 to 20 times more per sale than the average car company. What about NIO? 2.5 times sales. And look at their gross margin, 10.5%. That concerns me. Tesla's is 25%. I think, let's look at Honda and Toyota. Gross margin, by the way, guys. What is gross margin for those of you who are looking at me going, what the heck is this guy talking about? Gross margin is before paying rent, overhead, employees, how much they make on each car. If it's 10%, when they sell a car for $40,000, they make essentially $4,000. Let's look at Toyota. Toyota's gross margin, 17.2%. 17.2, that's almost, that's way higher than NIO's. Bottom line margin, 6.8 in the last year. In the last 5 years, 7.4%. Okay, so I look at these things thinking to myself, when I look at NIO and I look at all the things that they can, their potential, gross margin should be something that drives the company, whether they have a lot of fixed costs or not. This gross margin tells me a lot about their ability to make money. Now, they might be selling it for a low margin to get in the market, et cetera. Let's look at how many cars. This company's only been around for nine years or so. How many cars did NIO deliver in 2022? 122,486 vehicles. Okay. Now, fourth quarter of last year, they did 40,000. That's awesome. So a third of their deliveries in the fourth quarter. And China is a fast-growing market in terms of wealth. Fastest growing middle class in the world. 1.5 billion people there. They for the first time in like 50 years, lost population last year, and they still have a boatload of people who are getting wealthier and wealthier and wealthier. All right. So that's positives for NIO. The question is, how much is enough to pay? How low is low for NIO? When we look at 2.15 price to sales ratio, that's a lot for a car business, especially with this gross margin. However, they have the growth potential. So you should be willing to pay more money for NIO in terms of price to sales than you would for a Toyota. Toyota's not going to go up 10 times in the next 3 or 4 years. NIO could. Look at Tesla. Tesla did 1 million cars last year. Tesla's going to do 1.3 million or 1.4 million cars this year. That's big growth rates. Toyota ain't getting that. Honda's not getting that. Volkswagen's not getting that, except when they're coming off a really bad year and they get some big growth. But long-term growth is not going to be huge with those companies. You should pay more for NIO. Question is, how much more? Well, I don't know. And here's the reason why. Look at this profit margin, negative 30%. Negative 30%. How do I value a company that's losing 30% on its revenue? Look at this growth rate. 700 million, $1.1 billion, 2.3, $5.3 billion in revenue. But let's go on to their net income. Just massive losses, $1.4 billion, $1.6 billion, 800 million, $1.5 billion. That's a lot of losses. And they're diluting owners. They're selling shares to fund those losses. So what does that mean for you as an investor when I say diluting owners? What it means is if you buy a share today and they increase the number of shares by 50%, you now own significantly less ownership of the company, a third less ownership of the company. If they have 10 shares outstanding, you own one, you own 10% of the business. But if they need to get money by selling shares and they issue 5 more shares, you still own 1 share, but they've sold 5 more shares in the market to other people. So now you're splitting the ownership amongst 15 people and not just 10. Now you own 1/15 of the company, about 6.6%. That is why I get concerned about these fast growing companies. Even if they're growing like crazy, if they're diluting the owners in the business, you could see very, very, very little of the upside because they're diluting you. I can't stand dilution. In fact, a lot of investors won't even look at a company if they have net more shares in the last 10 years than they have today. 10 years ago versus today. If there are more shares today than 10 years ago, they're going to discount the company. They're not even going to look at the company. So for NIO, go back to our philosophy. I mean, look at the 8 pillars. I mean, high ROIC, which is awesome. Which in a small growth company, this is great. The question is, how reliable is this ROIC? But I mean, everything else is just bad. It's just bad. Negative free cash flow. I don't know. It's just a very difficult company to look at. Does that mean you should avoid it? No, but you need to build a model. You need to build a model. How do you do that? Well, first off, join our community. You get the software. People in our community have built models. You have to do it on Excel. Our software will be able to do it in the future, but for right now, we're not factoring in because I don't even know when are the losses going to stop. Even if I could build this, when are these losses going to stop? They have no indication that losses are going to stop. In fact, they're getting worse almost every year. So what do you look at with NIO? I would focus on the price to sales ratio for NIO. The stock has already fallen 85%. If you want to buy the company and you're okay with dilution, you got to really wait for this price to sales ratio to really plummet. How low? Maybe sub 1. Are you willing to pay a double premium for a company that's growing like crazy? Yeah, maybe. If it's at 1 and the other car companies are 0.4, 0.5, okay. But again, I don't know because I don't know when the losses are going to stop. What are their projections for the future? Are they going to sell? They could sell 5 million cars. Listen, that's the great thing about NIO. But BYD in China is also doing a great job for electric vehicles. Is NIO the best option for looking at electric vehicles? I don't know. I'm trying to look for more. Its current model portfolio, China new passenger vehicle market, and they accounting for about 2.7. In 2021, they were about 2.7% of China passenger new energy vehicle market. Okay, that's kind of cool. Man, this is a tough company to analyze. I'd love to be able to tell you, go out, this is the value of the company based on these assumptions. I don't know what these assumptions do. Let's go look at the stock analyzer tool. Now, this stock analyzer tool was used 1.3 million times. Now, here's where it's going to be difficult for a company like NIO. I'm going to put in profit margin and free cash flow margin. That assumes they start making money today. So I had to put a really high, that's not the case. They're not going to make money today. I had to put a really high desired return in here, and it doesn't factor in dilution. So whatever numbers I put in here are a complete guess. But I'm going to do it still to show our software and to show you how you can at least look at companies. This might come out with NIO being $1 on best assumptions. I don't know what it's going to be, but the point is it'll at least give you some idea of saying, okay, where does this look? So just hang on for 1 second. I'll be right back with my assumptions. All right, guys, so I made these assumptions. I did a 20-year analysis because if NIO is going to be around for a long time, I want them to be able to get the profitability, let them grow. Now, remember, the downside of these assumptions are 1, it assumes profit day 1, which is not the case here. And 2, it assumes essentially shares stay the same, and that's going to be kind of difficult. But let's look at my assumptions. I did a low revenue growth of 8% a year, high of 20% a year, middle of 14. Now, 20% growth a year for 20 years would take them to about $200 billion in revenue in 20 years. Okay, that wouldn't even make them close to the largest car company in the world. So, okay, that seems like it's something that could work out great. Now, should I go higher? You know what? I actually am going to go higher. I'm going to go with 10%, 18%, and 26%. Now, 26% revenue growth for 20 years would be equivalent to $500 billion in revenue. That's a huge number. Is it possible? I mean, current car companies are doing $500 billion a year, and they're not in China as much, so maybe so. And again, this is highest of assumptions. Now, for profit margin, I went low and said over the next 20 years, they're going to average 3% a year. I did 6, I did 9. I feel comfortable with these margins. Even though this is low, remember, they're going to have losses along the way, so they have to make up for that in the future. Same with free cash flow margin. I did the exact same thing. Now, PE. Remember, when it's a huge 20 years from now, it'll be a normalized company. So I did 15, 17, and 19 PE and price to free cash flow. And now for my desired return. Guys, I need to make huge money on this for me to decide to do this company. I did 15% a year on the low side because, guys, there's still a chance this company gets wiped out or they have so many losses that they just dilute the heck out of everybody. I did 25% on the high side and 20 on the low side. Now, I hit the analyze button. 6 numbers are going to pop up. A low, middle, and high based on earnings, a low, middle, and high based on free cash flow. Since the margins are the same, the numbers will be exactly the same. Okay, low side 250, high side 17, middle price 750. So my guess is that somewhere in this level here, assuming they start making money in a reasonable time frame. That's the hard part about this. So guys, if you like this, check out our software, everythingmoney.com, $7 for 7 days, $1 per day. If I asked you for $1 every single day, you wouldn't even remember it. So sign up. This will change the way in which you look at money. Thank you for your time.